Welcome to our recorded town hall, Thread Connects, and thank you for listening to this. And just want to let everybody know that this is going to be very content rich, and there's a lot of new stuff that came out, as everybody knows, from the new COVID relief bill that the president just signed. And so this is our version of interpreting that stuff for you guys. We're going to do a piece on PPP. We're going to talk about some of the stimulus items, and then we're going to talk about some HR related items such as the unemployment extension and some other things. So the great news is that this is recorded, so you can fast forward through things that you don't care about. So welcome. Thank you so much. I'm Lori Winters, founder and CEO of Thread. And I also have Scott Massley, who is our chief HR officer, who is going to help us out on the HR front. So without further ado, we will kick into what our agenda looks like today. We're going to talk a little bit about the stimulus payments. That's not really payroll focused, but we wanted to just kind of tell you what we know. And then we're going to talk about some tax provisions that have recently been, that are in the new bill. I'm going to do a little bit on the PPP update. I'm the PPP queen, I guess, unfortunately, or fortunately. I'm going to do some frequently asked questions, and then I'm going to turn it over to Scott. He's going to talk about unemployment, the employee retention credit, some WOTC, some other tax credits, FSA rollover, some things about requiring or whether or not you can or cannot require the vaccine. And before I start this, I just want to, I'm repping the ATL here. The Atlanta Hawks are 3-0. So it's a team in Atlanta that's winning. And so I felt like we had to have a little fun with that. All right. As always, I always going to say this. I hate having a disclaimer, but this information is constantly changing. And we know when it comes to government, it changes regularly. So this is based on current information that we have. It is not meant to take the place of other professional advice. We're interpreting what we have found out in this new bill that just got signed. So the first piece that I want to talk about is the new stimulus bill, the stimulus piece of the bill. So you probably already know this, but the current bill has stimulus checks of $600 per eligible adult and $600 per child under 16. So if you have a 17-year-old child, apparently that person is too old to get the $600 stimulus on. So that is how it is currently. They are going to use your 2019 tax return to determine eligibility. And there are some nuances around if you had not filed a 2019 return. I'm not going to get into that level of detail. But the president did want an increase. There's a lot of stuff going on in the media right now. I'm sure you're seeing it. The president wanted to increase that to $2,000. The House just passed that, and now it is in the Senate. We will update you when we find out anything else on that. On this slide, it talks a little bit about what you have to make or not make to get that stimulus check. And I'm not going to go into detail on this, but you have the slide. You probably have seen this, but there is an AGI, adjusted gross income amount, that you start to lose partial and then all of the stimulus amount. So that's for everybody here to see. And hopefully that clarifies it as much as I can clarify it. All right. There's some tax implications that came out in this bill, and I'm going to focus more time on this because this has more to do with what payroll, how it affects payroll and how it affects our clients and our prospects. So employers know that, or a lot of employers knew that they could defer their employees' payroll taxes, the Social Security tax, and that allowed the employees to take home more money for a short period of time. And since they were struggling, that was something that they decided to put in the bill a while back to allow them to defer that. But originally they were going to have to pay that money back. So employees were getting some money, less money withheld, but then they were going to have to pay it back by April 30th. So that was a concern. Now they actually have until the end of 2021 to pull that money back from the employees, whether you can increase the withholding a little at a time, and they'll have all of 2021 to pay that back. So that's a big deal for those that took advantage of that. It also allows temporarily 100% deduction for business meals. So those of you that are business owners and are filing tax returns, you probably know that you can only deduct 50% of business meals on your tax return. But as long as the expense is provided by a restaurant, this bill allows for a temporary 100% deduction for business meals. So this is business meals after the end of this year, after December 31st, which is coming up in a few days, and it expires at the end of 2022. So the purpose, the spirit of this is to stimulate spending in restaurants that were hit pretty hard by this. So actually it's a really good deal. You probably heard it out called the 3 martini lunch exception. That's really not what it is. You know, there's some negative media on this, but it actually was meant to stimulate spending in restaurants by businesses. This is huge. It clarified that the forgiven PPP funds will not count as income, which we already pretty much knew that. But the bigger clarification is that expenses that were paid with forgiven PPP loan proceeds are tax deductible. The IRS had come out and said it would not be, which basically meant that your profit would increase by the amount of PPP. And now that has been, the spirit of that was never to have that happen. So they did clarify that. It overrides a previous IRS guidance that said that it wasn't going to allow that. But any money that you use the PPP money for and that gets forgiven is tax deductible on your tax return. So that is a key piece that just came out that most business owners are going to be very, very happy about. And then there, this was just a little nuance that there's an extension to 2025 for employers to pay student loans up to $5,250 tax-free per employee. That was already in the previous bill, but they extended it through 2025. So one thing that I did read on this is you can choose either that, the loan payback option, or tuition assistance. So some companies pay tuition assistance. They could choose to help their employees pay student loans up to that amount, tax-free per $5,250 tax-free per employee. So that's been extended. I'm not sure how many people are going to take advantage of that, but there will be some. So I thought that was an interesting one to share. Now a little bit on the PPP. This is a huge piece of this bill. Some businesses can qualify for a second round of PPP money. So they already got the first round. Now they can qualify for a second round. They'll still have the 8 to 24 weeks, 8 or 24 week option. You can choose to end it anytime between 8 and 24 weeks. They did clarify that. Just like previous, 60% of this money must be used for payroll expenses and the rest towards eligible other expenses. In this bill, they've expanded the eligible other expenses to include some software cost, HR, accounting expenses, and some additional insurance products that were listed, life, dental, vision, and a few others. So make sure that you read that, and as that becomes clearer, we will get more information out. But I thought it was very interesting that they've expanded it to some software, some HR and accounting, because these things became super important for companies to navigate them through this time. I mean, Scott runs our HR division, and HR became more important than ever to help companies, navigate this crazy time. So it is capped. The amount that you can borrow is just like before. It's capped at 2.5 times your monthly payroll cost, but the maximum this time is $2 million. It was $10 million in the previous. Now it's $2 million. So they did max that out. But you can also have no more than 300 employees. So the whole goal here is to help small business with fewer employees. So that's why the max of $2 million is probably there. Here's the big caveat though. You must demonstrate a 25% drop in revenue between comparable quarters in 2019 and 2020. So those companies I can think of, restaurants, movie theaters, there's a lot of types of businesses, anything in the hospitality. that have really been hit hard and are continuing to be hit hard, this is a great lifeline for those type businesses. So you have to demonstrate a 25% drop in revenue, any comparable quarter, 2019 to 2020. So another couple things that came out, original loans that were 150,000 or less have now a new simple one-page forgiveness. So they did come out previously for the under 50,000 and made it super, super easy. But now loans 150,000 or less are now, the forgiveness application is very, very simple. Basically, you've got to certify how many employees you had pre and post loan, and it's gonna be pretty easy to get forgiveness now. This is a key one too. A lot of companies I know got EIDL, these emergency disaster loans from the SBA that came with a grant amount up front of up to $10,000. And originally that $10,000 or whatever that grant amount was that came with the EIDL loan was going to be deducted from your forgiveness amount. They came out in this bill, and it's no longer the EIDL grant piece of the EIDL loan is no longer going to be deducted from the forgiveness amount. So if you already applied, I read that if you already applied, you already got forgiveness, and you had taken a $10,000 deduction of the forgiveness due to the EIDL grant, there will be some way to go and get that changed. So make sure you look into that if you already got forgiveness and you got a $10,000 amount reduced. So those are the main points of the PPP that have just come out in the new relief bill. Second round of PPP money. If you're a client of ours, feel free to reach out. We will, you'll be able to get the report, same report that you used before, but the software will be updated for anything new that needs to happen in the application process. Reach out to your support rep and get help on that. So I put together, before we go on to the HR updates, I put together some frequently asked questions that I know our clients are asking about. And whether you're a client of ours, prospect, or partner, you're probably dealing with the same kind of questions. So number one that we get a lot, why do I have employees that end up on worksheet 2? So our system creates a report that you can use for forgiveness, for your forgiveness application. It gives you a tab for every piece of the application, worksheet 1, worksheet 2. So worksheet 2 is for the employees over 100,000. But we get this question a lot. Why do I have employees on worksheet 2, but they don't make over 100,000 annually? The main reason for that is in the language of the bill originally, and of the law originally, is any employee that on any pay period would have annualized them to $100,000, they will end up on worksheet 2. So for instance, you have an employee that makes $75,000, but they had a one-time bonus that if you annualize that payroll out for a year would have put them over the $100,000 threshold, they will be on worksheet 2, and that is the way that law is interpreted. So that's a big question that a lot of people wonder. That's why that's happening. Look and see if there was a bonus payroll that happened that would have put them over that amount. Do you have FTE issues? There's a lot of clients out there and companies out there that are having FTE issues, full-time equivalent employee issues, that are dropping their forgiveness amount down. In our system, iSolved, it is going to pick the most favorable comparison period. So you can compare your FTE count during the loan period to one of two options, January and February of 2020, or February 15th to June 30th of 2019. Our system is going to compare the loan period full-time equivalent employee count to both of those timeframes, and it's going to pick the one that's most favorable for you, for your company, to determine if there's going to be a reduction. If there is a reduction, don't forget you have a safe harbor option until December 31st. So you have until December 31st to get your full-time equivalent number up to pre-COVID numbers. There are some real weird nuances around this safe harbor that I've been playing around with some of my clients. But here's the way the safe harbor works. If you had a drop in full-time equivalent count from this arbitrary, strange timeline, February 15th, 2020 through April 26th, 2020, compared to the payroll, which included February 15th, 2020. So you take a payroll that included 2/15/2020 and you compare it to this 2/15 to 4/26/2020. If you had a drop in your FTE count, but you were able to get the FTE count back up to that February 15th number, then you have to get it back up by either which one of these is earlier, the day that you do your forgiveness application or December 31st, 2020, whichever one is earlier. And if that happens, you will meet the safe harbor. But what I have seen, there's some situations that are very strange, like your FTE count from February 15th to April 26th did not actually go down from the February 15th, 2020 payroll. So even if you got your FTE count back up, you're having a problem meeting the safe harbor. And I'm trying to get some understanding around that, because it just seems very strange that if you didn't quite go down, but it took you a little longer there was a lag in the amount of time it took to, start having to lay people off, but you were able to get that FTE count back up. In my mind, I think you should be able to qualify for safe harbor. Right now, the way it's written, you would not. And I'm seeing that in some clients' cases. So I'm going to stay on top of that and try to figure out if there are ways around that. But that's what you're going to see. So don't forget the safe harbor. It's a huge opportunity, even if you did not get your FTE count up during the loan period. There's also another safe harbor. It's called Safe Harbor 1. And I just cut and pasted the actual wording of this. If the employer is unable to return to the same level of business activity prior to February 15th, 2020, due to compliance with requirements or guidance between March 1 and December 31st by the Secretary of Health and Human Services, Director of the CDC, Occupational Safe and Health Administration, related to worker or customer safety requirements due to COVID-19. So basically, if you weren't able to get your FTE count up even by the end of the year, due to your state, your city being, whatever business you're in, being shut down for the most part, or having to stay at a very low percentage occupancy, things like that, there is also Safe Harbor 1. So don't forget about that. That is a real important piece to potentially help companies get full forgiveness, even if their FTE count was not able to get up. All right, and then the last thing I'm going to talk about on this is make sure you're taking advantage of all FTE exemptions. There are 4 of them, 4 major ones. If someone was termed for cause and you could not replace them, you get an exemption. If someone you offered them to be rehired at the same rate of pay, but they refused to come back, you get an exemption. If the person requested a reduction in hours, they don't have the ability to work they don't want to work full time, they're scared to work full time, whatever. If they requested a reduction in hours, that's an exemption. And if the person voluntarily resigned, that's also an exemption. So make sure that in our system, we need to put those in. We need to give you these exemption options, and then you can go in and pick the employees that qualify for those, and that will automatically calculate your FTE with those exemptions added in. So, and if you're not a client of ours, make sure you're talking to your payroll vendor, a payroll partner, to get help on this, because this could greatly increase your FTE count. So that's pretty much all I have for right now on PPP and all the other fun updates regarding payroll. And I'm going to turn it over to Scott now, who's going to give us an update on some of the HR pieces.
All right. Thanks, Lori. Great job. Go Hawks.
Go Hawks.
Go Hawks. We got somebody winning. So I know there's a lot of information here, and we're just trying to give you the highlights so you're aware of what has changed compared to what was the existing state before January and before this new stimulus bill was passed. There's a new round of federal unemployment supplements. It's going to be $300 a week instead of the previous $600 a week that people were used to. There may be an interruption in benefits. So you may have some employees whose benefits almost stop and then kind of restart. The $300 a week is not retroactive, so it does not go back and pay people back to a certain date or anything like that. It just starts on new claims going forward or existing claims for employees who are eligible going forward. It was designed to pay out for 11 weeks through March 14th, but there's a little detail that the federal government and the state governments messed up, which is the state governments can only cover certain pay periods based on when the law is passed. So they're thinking they're going to miss 1 week there, and it's going to end up being 10 weeks of $300 a week for people who are eligible. There is also a lot of confusion about the different kinds of unemployment benefits that were created this year through different acts and legislation that we've heard about all year. So I just want to explain as a reminder what some of these are and then tell you what's new with these as well as part of the stimulus bill. So the PEUC, the Pandemic Emergency Unemployment Compensation, what that originally did is said, states normally pay unemployment benefits out of state funds. So this PEUC added 13 weeks of federally funded benefits. So extended the normal length of unemployment benefits from 26 weeks to 39 weeks. But this new PEUC is extending, instead of adding 13 weeks, it's adding 24 weeks if people are already in that process. So if they're mid the 13-week extension already, they will continue to get benefits through March 14th up to 24 weeks if they're eligible for that. The Pandemic Unemployment Assistance, the PUA, is different. So the PEUC, what that did is gave people benefits for a longer period of time that was funded by the federal government. The PUA, the Pandemic Unemployment Assistance, is for self-employed and independent contractors, people who normally would not be eligible to get benefits at all. So the way it worked for those folks is they had to apply for benefits, get denied for unemployment benefits because they weren't W-2 employees, and then they could be eligible to get this Pandemic Unemployment Assistance. And now what they've done is increased that length of time up to 50 weeks total for them if they are already eligible or have a new claim that is eligible under that plan. So also self-employed folks or people who have a side job can get an extra $100 a week, because what happened was a lot of the self-employed folks said, hey, we're not getting the same benefit levels that W-2 employees are getting. So the government built in an extra $100 a week if the self-employed person earns at least $5,000 a year and they're disqualified from receiving the PUA, which was above. So it's almost like if they weren't already getting that and they start getting it, then they can get an extra $100. So we'll see how that plays out. The unemployment stuff has kind of been all over the place. So don't be surprised by anything. And I'm sorry to throw all the names of all these laws and acts at you, but I just want you to know what we're talking about. So the Families First Coronavirus Response Act. I think HR people get a bad rep sometimes for using so many acronyms, so we try not to use them. But in this case, we can't help it. I just want you to know what we're talking about. So you had requirements to provide emergency paid sick leave and expanded paid family leave under the Families First Coronavirus Response Act. And that act is going to expire December 31st, 2020. So at the end of this month, private employers are no longer required to do that. So just be clear about that. Starting January next year, you do not have to provide this paid leave, this emergency response leave. I had an HR person ask me today, for example, can I require employees to take their PTO before they use the emergency paid sick leave? And I said, well, if they're eligible for the emergency paid sick leave and it's this month, then you cannot require them to use their PTO first. But starting January, when you are no longer required to provide the emergency paid sick leave, then you can require them to use their PTO. And you can choose not to offer that emergency paid sick leave or paid FMLA at all, unless your state requires it. So with that, there was a tax credit that was an incentive for businesses to do this, right? To pay this money out, to track it through earnings codes like we set up for all our clients in iSolved at Thread. And the tax credit has been extended through March. So if a company chooses to say, look, I know I don't have to pay emergency paid sick leave, but I'm going to go ahead and pay that in the same way I would have as if it were required, then you can take a tax credit for that for all the money that you spend dollar for dollar on that kind of leave January through March 2021. So that is still available if you choose to do it. How do you track that? I would say continue using the same earnings codes that we set up for you this year, and that way you can prove that's how you spent that money, okay? There are caps, and the caps stay the same. They have not been extended, and I listed what those are here on the slide. The amount you pay employees are based on the reason that they're qualifying for this leave. So if it's a doctor-advised quarantine or a government like stay-at-home order, or the employee went to the doctor, has symptoms, and is waiting on their test, and the doctor said you need to stay home because you're waiting to find out if you have COVID or not, that kind of thing, then that's a $500 11-day cap. Regular pay up to $500 11 day, or $5,110 total over 2 weeks. The second one is $200 a day and $12,000 over 12 weeks if they're out on that expanded FMLA leave, which is only for people who cannot work from home because their childcare duties have ramped up because the school is closed or daycare is unavailable due to COVID-19. That's important too, because a lot of people are saying, hey, you need to pay me this paid FMLA leave because my kid's school is on a teacher work day or whatever. And that's not true. It's only if it was due to COVID-19. And then the last one is it's 2/3 of someone's pay up to $200 a day, $2,000 over 2 weeks, if they're caring for someone who is under doctor or government quarantine. And I think that's going to be something that all of us have dealt with recently. But again, all these requirements go away at the end of this month.
Ooh, clear as mud.
Yeah, I know, it's a lot. Okay, so here's another one, the employer retention tax credit. So originally this was set up last year, and I'm kind of showing you what changed from last year to this year. So if you applied wages, so you had to spend 60% of your PPP money on income pay, right, wages. So if you use that money towards wages for PPP forgiveness, you can't use that same money for this tax credit, retention tax credit. But if you finished your PPP money, applied forgiveness, and that's done, you have an opportunity now to get the retention tax credit. And what this is for is businesses who had a pretty significant drop in gross revenue quarter to quarter. The previous measure was if you had a 50%, I'm sorry, a 50% decrease in gross wages or receipts. Now it's to 20%. So if you can prove quarter to quarter that you had a 20% decrease in gross receipts, then you could qualify for this. And then what they've done is said, okay, what wages qualify? Well, this is for companies under 500 employees. If you have under 100 employees, you can pay people to work, even reduced hours under this. But if you have people who were not working, you could also pay them. So some of y'all remember this was going on originally so there were some restaurants who were shut down, but were paying their whole staff to claim this credit. And that can happen again. So wages between January and July 1st, 2021, it's increased from 50% to 70% of qualifying wages. And then the qualifying wages increased under this new stimulus plan from $10,000 a year per employee to $10,000 per quarter. So instead of getting a $5,000 per employee, you could go up to $28,000, depending on how much you spend on these employees and want to take advantage of this. So this has been extended and is another option for you to take advantage of.
Yeah, and now I think, did you touch on the fact that it's a 20% decrease? So it's not necessarily, it doesn't require as big of a decrease in gross receipts. So that's huge
Right.
too. And I could see companies that have been really affected negatively needed the PPP, but also this could really help, especially since it's extended through July of 2021. So a huge way to recoup some losses.
Yeah, the numbers have gone way up. So definitely take advantage of that if you can. Another thing that's included in this is some of you may already do this, the Work Opportunity Tax Credit is called WOTC. typically a form that companies include in their new hire onboarding that says, are you a veteran? You know, have you been unemployed for a certain period of time, or, you know, that kind of stuff. And you can see the list of groups that if you hire ex-felons or veterans or food stamp recipients, residents living in empowerment zones, anything like that, then you can get a tax credit. And the tax credit typically can be about $9,600 per employee, and the credits can go over time. Well, this program was set to expire at the end of 2019, then it was extended for 2020, and that's why this is here, because it was set to expire at the end of 2020. Now it's been extended all the way through December 2025. So you don't have to worry year by year. And what that does is a lot of smaller businesses or growing businesses who might have said, you know, it's too late for us to jump in on this. Now you have a much longer window here to take advantage of this work opportunity tax credit. And, you know, we've partnered with a group called Synergy that specializes in this, and we can help you determine if there's money out there for you to gain under this program. So all you got to do is let us know, and we will make introductions and work with you to take all the heavy lifting off your plate for this. And then we help provide the payroll information, since that's part of what we do. Also, there's no limit to the number of individuals that you can hire to claim the credit. So you can make some pretty good tax credit money here under this program. So if you haven't investigated this, it's worth looking at it.
Definitely. Awesome.
Another acronym, hopefully y'all know what this one is. The FSA is flexible spending accounts. So if you've ever had a flexible spending account, you know that it's usually a use it or lose it. You say, I want to put money in there. The employer has to fund it, whether, you know, you spend it yet or not. And then at the end of the year, everybody makes a big rush to buy Band-Aids or whatever they need to get to try to spend this money. That's why I always have like 2 pair of prescription glasses using my FSA money. But the caps are $2,750 per individual pre-tax for health FSAs, and then $5,000 per family pre-tax for dependent care FSAs in 2020. What the new stimulus has added to this is that you can roll over those FSA funds from 2020 to 2021 and from 2021 to 2022. So you don't have to worry for folks who have taken care of like elderly parents, for example, who have built up a chunk of money in there. You don't have to rush to try to spend that on stuff you don't need. You can roll it over for when expenses arise, and it's more, you know, convenient to use it.
Awesome.
Yeah. And then the vaccine is not something that's really included in the stimulus bill, but we're getting a lot of questions about it. So we wanted to go ahead and talk about it while we're here. We can provide Thread and Thread Engage, the name of our HR services. We can provide for you a vaccine policy, whether you want to require it or not. We can provide a vaccine declination statement for you if you are encouraging employees to use it and they have the option to choose not to, that kind of thing. So there are multiple states that are already working on passing legislation to prohibit employers from requiring the vaccine. Specific court areas, you know, districts who are known for kind of this kind of stuff, they're already going after this. So just keep your eyes open for that. But as of now, the federal government, EEOC, the Equal Employment Opportunity Commission, OSHA, CDC, they're all saying you can require vaccines if you meet certain criteria. So if there is a job necessity, meaning that your employees, if they did not get vaccinated, could create a direct threat to the public or others. So these are, you know, dental workers, doctors, people in the doctor's office, retail employees, the person at the grocery store, the Home Depot, people who are around big groups of people a lot, if they did not get the vaccine and had COVID, could spread it to a lot of people. So that's kind of the job necessity measure. It's very vague. So the direct threat is what you think about. If it's not something that's going to create a direct threat, then it's not a job necessity. If you have a guy who's doing surveying by himself all day in a field, that's not going to be a job necessity, right? But also you have to build into your policy that you will accommodate those who might have a disability, and especially those disabilities which prevent them from receiving a vaccine, and then also accommodate religious beliefs that conflict with vaccinations or conflict with vaccinations. And then you could deny the accommodation. So let's say someone requests a disability accommodation or religious accommodation, if you have explored all of your options and there's no alternative that exists to reduce the direct threat of harm, then you could deny that accommodation. Now, this is all going to be litigated like crazy, and it's going to be very political and all of that. But what you should do as an employer is say, I'm not getting into politics and religion or how you feel about vaccines or any of that kind of stuff. All I'm talking about is protecting our employees, our team members, our clients, our patients, and you can either require them to do it or you can encourage them to do it. Now, outside of the law, the HR advice is if you say you are required to do it, you are probably going to lose a few employees who are just going to, be a martyr and make a stand and say, I refuse to get that vaccine. So just be ready for that. If that scares you and you say, I really cannot afford to lose anybody, then think about encouraging instead of requiring and kind of working from there. So the statement that we have that says, I understand that if I choose not to get the vaccine, then I have to monitor my temperature and my symptoms. I understand that if I'm sick, I can't come to work. If I miss time from work due to this, it will be unpaid time, et cetera, et cetera. So that's kind of what that says if you go that route.
So difficult this time, but
Yeah.
yeah.
So I touched on this a little bit, but if you have a voluntary program, like I was just saying, then employees can opt in. And the advantage of this is there are other issues with requiring someone to take a vaccine. And that is before you take a vaccine, they typically ask a lot of health related questions, right? Do you have this? Do you have that? Do you have a family history? All of those questions can cross the line on other employment laws like GINA, the Genetic Information Act, and Americans with Disability Act and HIPAA and other things like that. So if you have a voluntary program, employees can opt in, which means they're also opting in to answering those questions and to getting the vaccine, which reduces all that liability. It's also better for morale for people who are going to really want to make a stand against it. And also if you require the vaccine and an employee gets sick following the vaccine, then there's a chance that that employee could come back and say, I would not have done this otherwise. You made me do it. You paid for it. And now I'm sick. So who's going to cover that, right? And that has not been decided. There's a lot of debate right now whether or not workers' comp will end up covering that or not. And we'll just have to see how that goes. But that's a real possibility. Another question I've got about vaccines is what if we have a waiver that basically says, you understand that if you choose not to get the vaccine, that, blah, blah, blah. But also a waiver that people are more commonly asking about is what if we require them to get the vaccine? Can we include a waiver that says if I get sick due to the vaccine, my employer is not liable? And that depends on what state you're in, because some states will not uphold those kind of waivers. They'll say you're making them do it, and that's what caused them to get sick, and that's all there is to it. So less risky option is voluntary.
It sounds like the attorneys are the ones that are going to win with all of this.
Yeah, as usual, all the attorneys are going to have another big year in 2021.
Yeah.
And we, as our HR service at Thread, one of the things we try to do is we love attorneys. We work with a lot of them, and we appreciate what we do, but they know and we know how expensive they are. And we try to help you reduce those costs. So most of our HR advisors and our team, when you call us, we can eliminate the need to call an attorney 90% of the time. And for many of our clients, we've decreased their attorney fees a few $1,000s a month from what they were spending before they started working with us.
Awesome. That's all you got, right, Scott?
That's it.
Well, we just thank everybody for listening in, and we hope that this has been valuable information. We are going to stay on listening and paying attention to changes out there, because anytime there's been a new bill, there's a lot of gray. There's a lot of muddy waters out there. We don't really, we don't have answers to everything, but when a new bill gets initiated or submitted, there will be clarifications that will be coming. And as clarifications come, our job is to get it out to you guys as soon as we get it. So that's going to be our goal, is to continue to do these, whether live town halls. We decided to do this one recorded because it's a week between, it's a holiday week and New Year's coming. And so we decided to let you guys watch this at your leisure. And we'll keep getting content out to you as much as we feel like the more clarification comes. And, obviously we would love, if you're not a current client, we'd love to have an opportunity. If your current payroll and HR or HR partner are not delivering as well as you would like to see, we would love to partner with you. So always reach out to us if that sounds interesting to you. And we just appreciate you, tuning in on this. Scott, do you have anything you want to add?
No, we'll be digging into what HR expenses are covered. Maybe you could get all your HR consulting fees covered and then take advantage of our services. That would be great.
Yeah, the new other eligible expenses is interesting.
Yeah.
Well, thank you so much. And we just appreciate our clients and of course, and we appreciate our prospects and partners as well. So thank you and have a great New Year's.
Happy New Year.